we are going to run out. We've already run out of taxpayers pretty much, and we will eventually start running out of savers as well.
What are the significant factors that ordinary South Africans as well as businesses need to consider from today's budget? Here to discuss this and more is Chief Economist at Efficient Group, Dawie Roodt. Dawie, I just wanted to get a general sense as to what are your sentiments towards today's budget speech?
Well, actually, I'm actually quite upbeat. I'm actually quite positive about what can be expected from the Minister of Finance. And the main reason for that is simply because of the commodity cycle in which we are in at the moment, which is a bit of a mini boom cycle, certainly. And that is changing all sort of things in the budget. Maybe just a comment. People refer to this as a budget speech like you've just done. And it's not really a budget speech. It's just a report back on an opportunity for the Minister of Finance. He's not going to make any changes, or unlikely to make significant changes as far as policies are concerned. But I think he's going to sound a little bit more upbeat. I think the big numbers are going to look a little bit better, and it's primarily because of the commodity cycle that we're currently experiencing, with commodity prices quite high, meaning that the tax revenue of the Minister of Finance is going to look significantly better.
Enjoying this analysis? Click here to sign up for our 30-day free trial for more content from the CIA.
Yeah, so I did also see that myself, Dawie, that they're expecting to collect. I've seen certain estimates that revenue might be up by about 130 to 160 billion from the February number. Now, isn't there a potential risk that with the short-term increase in commodity prices that then a national treasury could then start to implement populist policies that might be detrimental to the South African economy?
Without a doubt, and that is the big danger here, is there is huge pressure on the Minister of Finance to expand or to spend more on social expenditure or various kinds of social expenditure. And if you compare South Africa to the rest of the world, that we're spending much, much more than most countries on social spending, all kinds of social spending, things like education, for instance, the various grants, all those sort of spending items are far higher compared to other countries in the world in relative terms. Also, we're also spending huge amounts of money on wages on civil servants. And now that we have more money, of course, everybody's putting pressure on the Minister of Finance to spend even more on those sort of items. But the big danger certainly is, and you're absolutely correct, is that once this commodity cycle passes, the spending is still there. It's very easy to give somebody something. It's much more difficult to take it back. And that's the danger. Once we implement or start spending more on the wages, and that's a potential danger here, or if you spend more on social expenditure, like, for example, you extend the grants, it's not going to be easy to reverse that once there's a windfall that we're currently experiencing, once that passes. Maybe I could just mention that even with this much better collection and spend in the revenue that we're currently experiencing, the trajectory of the fiscus is still totally unsustainable. We've got fiscal debt levels that's been going up very strongly in recent years. It will continue to go up for years to come, even if the commodity cycle is with us for quite some time. But the big danger is that he's going to commit to other levels of spending and other items of spending, or increase other existing spending items. And I'm afraid going back on that and reversing that is going to be politically nearly impossible.
And the result of that, unfortunately, would be an increase in debt levels in the country. Now, we've had a rebase, Stats says rebase GDP in the country, making debt levels seem a little bit lower than what they were in February. But then what's important, Dawie, I think, is the trend line of debt, and that's going up. What is your sense then? Is it possible that we might actually start to see debt levels reaching that 90% levels in the coming years, or perhaps even 100%?
Yeah, you're absolutely right. There are two important numbers that you're referring to. The one is the actual debt. Now, we know what the debt is. We can calculate that. And usually we refer to national government debt or national debt, and that excludes things like, for example, Eskom and the other parastatals. But actually, those debt should be included as well, simply because so much of that debt is guaranteed by the state. But excluding them for a moment, the debt is currently running around about 70% of GDP. The fiscal deficit is currently running, it's probably going to be around about 6-7% in the current financial year. And next year, we're talking about the fiscal debt levels or expectations around about 5% or somewhere in there, depending, of course, on things like, for example, the commodity prices and the like. But that's the problem, is that debt, 70% debt is already higher than our similar kind of countries in the world. Of course, there are many countries with much higher debt levels, like the Americans and so on. But the big problem is not necessarily the debt level. The big problem, there are two big problems. The one is that we're adding to that debt at an unsustainable rate. That means the fiscal deficit is, even if the fiscal deficit is coming down a little bit this year and next year, it's still far, far, far too high. And we have to run a fiscal deficit roundabout in line with economic growth. And the longer-term rate of economic growth in South Africa is approximately 2% or so. So that's where the fiscal deficit should be, around about 2% to GDP. And it's multiples of that. So that's one problem, the rate at which we add to existing debt. And the other problem for South Africa is, of course, that the interest that we pay on debt in South Africa is far higher than most other countries in the world. If we borrow money in South Africa, we borrow money at currently close to 10%, depending on what period we're talking about. Currently, it's about 9% that you pay for 10-year money, and compare that to the rich world, where they pay, in some instances, below zero. So that's the problem. It's not necessarily the level of debt, but it's the rate at which it's increasing and the price that we need to pay if we want to borrow money.
On that topic there, Dawie, you touched on the interest in which the South African government actually service its debt levels. I think you're referring to the 10-year bond, to the 10-year South African bond yield. Now, as you might have seen, Dawie, is that a lot of these central banks around the world are talking about tapering and then starting to increase interest rates.
Yeah.
What will the effect of tapering be on the South African 10-year bond?
Yeah. Well, basically what will happen with what they mean by tapering is that the big central banks in the world, like the Fed and the European Central Bank and Japanese Central Bank, and even the Bank of England, what they're doing, they're buying a lot of financial instruments in the financial markets, mostly state debt instruments or government debt instruments. And the result of that is that they're forcing long-term interest rates lower. Now, South Africa is part of the rest of the world. And whatever happens in terms of monetary policy globally will eventually affect us. And we have to follow the trends, the monetary policy trends internationally. And some of these central banks, big ones, they've indicated that they will reduce the amount of financial instruments that they will be buying over time on the financial markets. And they call it so-called tapering. And then the effect of that is it's a slight tightening of monetary policy. Now, usually when we talk about monetary policy tightening, it means interest rates are going up. And that is eventually what is going to happen. Interest rates will eventually start going up internationally. And some central banks already started increasing interest rates. So this is the first step in a tightening cycle of interest rates internationally. Keep in mind, however, that the amount of debt that we have on our books have already been borrowed at a fixed, mostly in most cases, not in all cases, but at fixed interest rates. So if interest rates go up, government is not immediately going to pay more on interest, or not in most cases, on interest on existing debt. But if they want to borrow more over time, then eventually interest rates will start going up, and then in future they will have to pay more for debt over time. So immediately there won't be an immediate impact, or much of an immediate impact on debt, on state debt levels. Or interest on state debt, but eventually it will. So the bottom line is, when monetary policy gets tightened internationally, it will spill over into South Africa as well, and we will have to start tightening monetary policy as well, meaning higher interest rates, and higher interest rates when you have a lot of debt is going to make life much more difficult for you. So that will make the current trajectory, which is already unsustainable for the fiscal accounts, even more unsustainable. So that's a very important variable to keep an eye on, and that is what is going to happen as far as monetary policy is concerned internationally, because eventually that will affect a local monetary policy as well.
And from what I'm getting a sense of what you're saying there, Dawie, is that then the government taps are then going to begin running dry in future. And Enoch Godongwana was the main proponent of prescribed assets last year, and that has toned down into this year.
Yes.
Well. Now, isn't there a risk that when government coffers then run dry, that we might actually start to see an introduction of some sort of prescribed assets, as the government is then trying to take funds from the private sector in order to fund government infrastructure projects?
Yeah, we've been talking about the debt levels that keeps on going up. And that means that the government needs to borrow a lot of money because of the huge fiscal deficit. And remember, interest, you don't have a choice. You have to pay interest in your debt, but you have a choice on other expense items. So the Minister of Finance, he can try to, politically it's not always easy to do that, but he can try to spend less on social expenditure or some other expense items, for example, but he has to pay interest. Of course, if you stop paying interest, that means that you default on your debt, and that's not a good thing. But if running a huge fiscal deficit like what we're currently doing can be funded, and it can be funded because of the South African financial markets, especially the capital market. It's quite liquid, and there's a lot of sufficient amounts of savings coming from pension funds currently sloshing around to fund that deficit. But eventually, when the economy, the deficit keeps on going up, and eventually the state will start taking more of this existing pool of savings out of the economy, and eventually they're going to run out of savings. People are going to say, listen, I either demand a much higher interest on the money that I'm going to lend you, or we can literally run out of existing or potential savings to fund the fiscal deficit. And then the Minister of Finance will be in a bit of a predicament, because if you want to attract more savings, or if you want to borrow more money, you have to pay higher interest rates, and people don't want to lend you money. And then eventually that may force the Minister of Finance to try to fund some other sources of savings. And that is where prescribed assets come in. And already pension funds and other institutional investors invest a lot of money in government debt. But maybe one day the day could come, and there has been rumors, we all know this, you and I, we've been speaking about this. There are rumors that there could be some sort of super pension fund over time. And of course, if there's the idea behind that is to force some of these pension funds to invest in prescribed assets. Of course, they're going to give it another name. They're probably going to give it an infrastructural development fund name, for example, requiring the funds to invest in this infrastructural fund, for example, and that fund then will be used to fund things like, for example, Eskom and likes. So I'm afraid, yes, if we keep on this trajectory, we are going to run out. We've already run out of taxpayers pretty much, and we will eventually start running out of savers as well. And then the only option open to the Minister of Finance is to go to the only remaining pot of gold in the country, and that will be the savings pot of people saving money for retirement, and that is the pension funds, of course. So that is a real danger, without a doubt.
Thank you, Dawie, for your brilliant analysis, sir. The CRA will be hosting a webinar on the 12th of November at 10 a.m. I'll be co-hosting it with David Nsaro, who's the Chief Operating Officer. If you're a CRA client, please click on the link below to register for the webinar. And if you're not a CRA client, please click on the 30-day free trial to get access to the webinar. Until next time, take care.